Mark, the question that I've been asked over the last week is A, are there any good back tests? B, 0 day seems to suck right now. Those are the two things that I have heard. I want to be an advocate for the people today. I'm going to ask you the hard hitting questions and let you use your expertise to answer them. A, are there any good back tests? And B, why does the market suck so bad right now for 0 day?
Yeah, so like there are a few back tests that are good, but I would say similar to kind of, I think it was a butterfly or something that we did a few weeks ago, they're structurally based on volatility, which are never the good back test, over a long period of time. But those are the kind of things that are make money when you're buying an option and you're selling an option that has like a structural difference in price. Think about a call spread, you're into that skew, certain calendars and such. But, running a fund and like we're starting to get to the institutional track record, I have been getting absolutely grilled on due diligence by like, multi-$100 million funds and such on like what is going on with 0DT. And it kind of like changed my entire perspective of how to answer this when I got down more to it. So like I would generally answer like, oh, VIX is low, regime, yada, yada, yada. And like those weren't really accepted as answers. So I knew everything that was wrong with backtests. And I kind of like went down through a rabbit hole of basically how to define this. So 99.99% of everything you see on the show and everything people do, people are optimizing based on a large set of past data, which is the literal definition of curve fitting. It is not robust. It is optimizing based on data you have basically in sample from the past, and you're only using that data to determine what is best for the future. So basically, all the information before you make a decision on how to trade. Whereas the gold standard to basically look at that is walk forward analysis, 2008, Robert Pardo, evolution optimization of trading strategies. Basically, what this does is you take different segments of data, whether that be 3 months, and then you train on that 3-month data, and then you see how well it does in that 1 month out of sample. So you're training on the data that you currently have, and you're basically saying, okay, 1 month in the future, not knowing how those results are, what if I optimize based on 3 months, how close am I in this 1 month to those results? And you basically do that on different iterations. So when I go through 0DT, I was testing what 90% of people run. And this is also why you should not be doing like gap up, gap down, et cetera, because you're just curve fitting, which is what I constantly put it on the show. But we need to understand like what are the expectations around what I'll call vanilla, which will be EMA every 15 minutes, MEIC every hour, however you guys basically do it. And when I ran that through walk forward, I basically used 3 periods, and this is going back till about 9 months before SPX dailies, so 2021. So SPX dailies is the first data set that we're testing on out of sample. And I ran it in 3 periods. And the reason you do 3 periods is to see how you slice it up that it maintains consistent. I did a quarterly period, so 63 trading days in sample, 21 days out of sample. I did a medium, 126 days in sample, which is 6 months, 2 months out of sample, which is 42 days, and then a long, which is 252 days in sample and 63 days out of sample. So the short is going to be basically the most conviction because you have 50 out of sample tests to do it on. The 6 month to 2 month is kind of going to be the Goldilocks with reliability and consistency. And then the long term is only going to be basically 13 iterations to kind of see how we did on quarterly.
Let me stop right there real quick. So you're saying something that I think most people don't realize. I think most people would say, oh, you just did it backwards to how I thought you do it. Where the farther back you go, the safer it is, the more reliable it is. And you're saying, no, the most recent data set is the most reliable because it's the quickest you can forward test. Is that correct?
So we want to separate 2 things where we look at what is robust. Robust would mean if we had a 2 sharp and we got a 2 sharp, that would be robust. Whereas the counter to that would be if we looked at a year data set and we had a 4 sharp and we got a 2 sharp. Even though you got a 2 sharp, you'd be happy, but that is terrible from a walk forward perspective because the data you trained on did not get even remotely close to what your result is. And this is what I think most people seek to do this. And there are metrics that we can base this off of. So the basically most important metric for all of this when we're looking at it is going to be our in sample versus out of sample basically return ratio, which we're going to use a p-value. And for what people to know what a p-value is, basically you're going to look at the in sample period versus the out of sample period. And if you have a p-value of 99, you're basically confident that it's random. So your out of sample returns are not influenced at all by your training data. So and what most people do, and I used to do this, is I would use the p-value of 3 years of back test and say, hey, versus flipping a coin, does this strategy have edge? And it would always be like 0.00001. But does that kind of make sense? So
Yes.
You're basically saying that if in sample is what you're training on, and we're calling that basically the benchmark, when you're training off the data to data you don't see out of sample, how random is that in between? And this isn't going to be 0, 0, 0. You just don't want it to be 99. So when I look at basically like vanilla type rules, we have our results here are, pretty good actually. So our in sample p ratio is 0.02 for the short, our medium is 0.2, and then our long is 0.36.
Are you sharing something?
No, I'm just reading it off.
Okay. I didn't know. Oh, gotcha.
I think this will confuse people. So basically, uniformly, we see that there is an edge here, but more data makes the optimization more predictive, which means that if this was overfit, we would see the opposite pattern, basically a negative p-value. However, what this does kind of say to us is that in any 1 month period or any quarterly period, it's kind of noisy. So like when we look at staying the course on MEIC, it's very driven by regime, and we can't really derive benefit from guessing times or, changing our size or whatever that may be. We can theorize a little bit that cost of execution goes up and lower volatility. So maybe you trade less, like a minimum VIX filter of like 15. However, if we look at like 2017, the VIX was 10 and it was still very overstated. So that's also kind of a dangerous assumption to make with that. Then when we also look at basically the walk forward efficiency. So basically what this means is that it quantifies if you're fitting to noise. So the higher the walk forward efficiency is, means the in sample is capturing what's in your back test. So for vanilla, which is just MEIC and EMA, in a short duration, we have a 58% walk forward efficiency, which is quarterly, monthly. Then if we have 6 months, 2 months, we have a 25% walk forward efficiency. And then long term, we have an 89%, which would basically be a yearly walk forward efficiency. So what this kind of tells you is if you're above 50%, it's like pretty decent. But being short is 57% and medium is 25% and long is 88%. This basically means that to get the results of your back test, you should plan on actually running it for 12 months till you get close to the mean. So that is the most core thing I would kind of like to share with people for these are statistical expectations of what you're doing. Is short is pretty noisy. Medium's almost impossible. So like 2 months, it's a bad metric. So like 50% is considered good. So we have 58% for basically 3 month, 1 month. We have 25% for 6 months, 2 months, which is atrocious. And then we have 88% for yearly, quarterly, which is, again, very good. But for everyone that thinks they're basically dying here, the last one is degradation of slope, which this tests the edge decay. If it's significantly negative, this means it's losing edge. If it's non-significant, there's no evidence of edge decay. So for the short term, we have a p-value of 0.72. For the medium, we have a p-value of 0.81. And then for the long term, we have a p-value of 0.34. So this basically shows that the edge has not decayed on any long-term period, but it routinely decays in the short term of monthly and quarterly. So, and then, if we go an entire year, I would obviously change my tune about this and say the edge in 0DT is gone. But this 3-month period and 6-month period is still well within what's expected. It happened in late 2023 and it happened in mid 2024. And now it's happening late 2025. So this is a very normal iteration of basically what is expected. However, it's worth basically looking at, and also the Sharp of the in samples and out of sample periods ranges from negative to basically 20, which is what it was in like April. So this is just a classic that there is genuine risk premium in selling options, especially in 0DT, but the patience and expectations of what we need to realize this are much, much longer than I think what people expect. And I think people are doing themselves a disservice when they run something that's basically curve fit. You're using all the data, from the past to backfit to the backtest best. I never lose it in a month. Well, you're structurally like testing the wrong opinion because you have all the data and you're training your backtest to fit it to that. So good news is I have a rules perspective that, parses the option chain for information that shows genuine edge with all this stuff. So I'm leaning more towards that now. But patience. Patience is kind of the key to, I can answer more questions. I'm still working on getting better at explaining this because this is a recent revelation like the last 2 weeks. But
Well, this is the thing too. Again, I like Jim Simons a lot because he kept a humble. Everything I've ever seen of Jim Simons, for those who don't know Jim Simons, it's Jim Simons, right?
I'm saying that. Yeah, Jim Simons.
Yeah. The thing about math is the promise of math shows a consistent pattern through time, which is why we use math, but also the problem and joy of humanity is that we're always learning how to deal with those constants and interpret those constants. An interpretation of constants is the whole name of the game with any of this. That's why really smart people fail and really dumb people succeed sometimes, is how you do that. And so to me, what I hear you saying is, from a 0-day perspective, we are well within the means, in your research at least, of what is an expected drawdown. And so for those who are just starting 0DT, newer traders, you think this sucks, this doesn't work, why did anybody ever do this? That brings to the second point, which is the importance of position sizing and allocation percentage. And I've always said, Mark, that allocation is a strategy. Like, it's part of the strategy. You can't separate. You can't separate them out. And so starting small with this type of stuff is the name of the game. I think maybe next week we'll look at more we'll get back to the normal row of things next week. But one thing I'd like to talk about next week a little bit is how you approach position sizing when you're doing your analysis of this. And that might be a quick subject, it might be a long subject, but I think a lot of people be interested in knowing, like, someone who's dealing with outside money, larger money, people asking more serious questions, people asking, you're not dealing with just you at this point. So the question of how do you adjust for risk with sizing is something that I think a lot of people would benefit from your answer on.
Yeah, I think another thing that people can take away from this is, like, I get this, I'm sure you get this with Option Omega too, is like a bunch of people will like copy what I share on YouTube, and based on sampling, they can do amazing. So like someone could come in the beginning of March of this year and start tranching 0DT and like absolutely kill it. Or they could come in lately and like not kill it. Or it's like, I even know a guy that came in October, which has been a bad stretch for 0DT, but he was trading 75 wide MEIC and didn't sell his longs. So he's like, I'm up 40% because he made 35% off his long wings. So like that sampling is going to naturally be it. And the thing that I think people also get wrong is they'll be like, well, someone's making money, and we'll look at all the discords and who is like using AI to find the best time or the best mechanic or the gap up. And they're like, oh, I'm going to follow this because this guy's making money. But if we think about it, and we can see from this data, at least tranching MEIC, it's like there's no predictive ability to predict the times of MEIC that are going to make money. So like when people are doing that, it's the same thing as coming in right in March. It's a sampling effect. So if people decide to go really heavy on 2 p.m., noon, 9:45, if there's 1,000 people in a Discord, and like there's going to be 24 bodies that tried unique times and different stops that won't share their results and say it doesn't work. And there's going to be 1 out of 40 people, just from a statistical perspective, that picked the new best time, and it wasn't really through their data analysis. And that's not really the route to be like going through. I mean, certain things are kind of obvious. So it's like VIX goes up 932, like you can test that independently, like you can trade that, and like it's persistent till like 1030. But you trading a 1x condor at 218 with a different stop or whatever it is, I can promise you that you're fitting the noise. And like you send me the Excel file, I'll run it for you. It's not like that difficult. Like this is the gold standard. Like I read.
Flip it upside down. Flip it upside down. There you go. Oh, well, it's still backward. Yeah, we'll put it in the show notes. Yeah. It's mirrored right now. So I mean, I think that's the thing. And Nassim Taleb talks about this quite a bit in Fooled by Randomness, one of my favorite books of all time. The idea of saying, given enough monkeys in a room, over time, one of them will produce Shakespeare. Like there's this nature of randomization that, there are certain investors that seemingly fly by the seat of their pants and they're successful a long period of time. There's traders that are very systematic who are very successful over time. Which one's correct? Well, the idea of data being randomized makes it very difficult to interpret which one's correct quite often.
Yeah, I'll like slightly double down on that. So I'll say that it's like people are lucky or they're talented. It just so happens that you can't replicate either of them. So like I do think there's a anomaly of like 1% of 1% people. Think about like you being 6'2" versus you being 7 foot. It is not near as hard to make the NBA when you're 7 foot. You actually have like a 2% chance basically to make the NBA. Whereas if you're 6 foot, you have to be very good. So the key is like you're not 7 feet and you're either really talented or lucky, or who you're watching is really talented or lucky, and both those are very difficult to replicate. Where what I like to say is that trading or whatever is an art, but math and everything is exact science. And like the last thing I want to say, because remember all this done, is like from the walk forward optimization, the story of vanilla strategies, MEIC and EMA, is that edge or risk premium exists, but is regime dependent. And it has a significantly higher drawdown than what is implied from past performance, and has inconsistent out of sample profitability. So in the other thing, when we talk about regimes, is like you can't necessarily define this by VIX, because you can have a VIX of 30 and it can be significantly understated, i.e. 2020. And you can have a VIX of 10 and it can be significantly overstated, 2017. So you can't just necessarily plop a filter on. Like there is a lot of warrant to, don't trade straddles. Like when you get to 230, volatility is low because there's not near as much risk premium at the money as there is one strike away. So there are small things you can do to optimize this, but like a flat VIX filter will not fix this, because like the VIX at 15 reflects what's currently priced in, not if it's over understated. There could be nothing going on, which would basically, drag the performance and or not drag the performance based on what's overstated. Like if we go into a war and the Cuban Missile Crisis happens, a VIX of 60 could be significantly understated,
That's right. No, that's exactly right. Buying a straddle, I mean, this is the point of the joy of data too. Like buying a straddle in April when VIX was 40 would have been a suicidal move using past data sets, except for that day we went up 10%, and that straddle actually made money. And so that's the hard part of anyone. It's exactly what we're talking about. So listen, lots of meetings to go to today, so I've got to cut it short, unfortunately. But Mark, this was awesome. I think people should watch this. I think there's a lot of stuff we can do with this. And I think these type of talks every once in a while will inform how to improve our back test as we go. So I appreciate you diving into it. So guys, settle in, watch the video again, be live, and we will talk to you next week. Have a good day.